Welcome back to the program. Now, global markets have taken a hit on concerns about the looming end, or at least tapering, of quantitative easing in the US. It comes as Japan's central bank pledges to continue its aggressive monetary easing policies. So how reliant are global markets on QE programs? Well, for more, I'm joined by Marcel Von Pfyffer, the Managing Director of Arminius Capital. Marcel, great as always to have you on the program. Look, just speaking to Mike Kendall about the impact of central banks on markets, are they the dominant theme or the dominant influence, do you think, on global markets?
Yeah, totally. I think dominant is a very good choice of words there, James. The reality is what's happening at the moment, what we've been going through since November last year, when the head of the ECB pulled out the line that he will do whatever it takes to rescue the European financial system. So ever since there, it's kind of been a bit of a lay-down misere as far as the investor is concerned. Talked about on this show before, what's really happened in the last 6-7 months is the quest for yield. So as we know, the central bankers world over, in Europe, led most recently from Japan, of course, but again, not to forget that little bank in New York called the Federal Reserve. They are structuring the yield curve in such a way that it's making the stock markets very, very attractive to investors, simply because if they keep their money in the bond markets, they get next to nothing for it.
However, we are seeing any utterance from a Fed member, whether or not they be a voting member, whether or not they'd be a well-known hawk or dove, any sorts of utterances is having, enormous ramifications for markets. I mean, is it being overdone considering Ben Bernanke's rhetoric for months now?
Yeah, I think the strategy that the Federal Reserve in the US has begun to employ over recent history of far more open communication, in this instance perhaps has come back to haunt them a little bit. So that the person that you're referring to there, of course, is none other than Mr. Fisher, who's the head of the Dallas branch of the Federal Reserve Governor Network, and he is very much the opinion that the $85 billion per month of bond purchases that the Federal Reserve is enacting to try and create some inflation in their economy. Mr. Fisher there is of the opinion that this should actually end sooner rather than what the other remaining governors of the Federal Reserve Board system think. So when you've got one member dissenting, as you say, the communication that Bernanke perhaps would like to see coming from all of them leads to a little bit of disjointedness in the markets. So what we saw late last week with the jobs number that's come out, 176,000 people were of new jobs that were added to employment. The governor of the Dallas Fed, what he understands, and I think what he's been able to portray to the markets, really is that that's actually not such a good number. So when the market understands that 176,000 might sound like a lot of people, but those in the know understand that it's actually not quite good enough to get employment down at the pace that Bernanke wants them to, or wants it to come down to, means that the market understands that QE will actually continue. So the problem with Mr. Fisher communicating his perspective on where monetary policy in the US should be heading was a little bit in contravention of what the rest of the market interpreted from that number.
It's a little perverse though, isn't it, Marcel? The idea that a set of numbers that might point to not the greatest health or greatest growth trajectory will actually be welcomed and send equities up, and as opposed to the flip side, when you get good numbers, and that's seen as a bad thing because it means that the sugar rush of QE might start to be tapered to some degree.
That is 100% completely correct. And again, the irony, if I can quote you here, the sublime irony of the situation, as I say, is that number was actually very poor, and the market, which has become, if you like, addicted to quantitative easing, looked at that jobs number, knew that it was very low, which meant that QE is not going to end anytime soon because, as Bernanke has categorically and emphatically said, is that QE will continue as long as the unemployment number remains high. So what that number last week did was actually increase the unemployment number, so it's 7.6%. and what economists say is full employment in the US is about 5.6%. So, as we're discussing here, 176,000 jobs in 1 month is actually well below par. The last 6 months, on average, the US economy net has added about 194,000 jobs per month. So, even at that rate, even at 194,000 jobs per month, which what a recovering US economy has been doing for the past 6 months, it's going to need to continue to put on 194,000 jobs a month for 8 years.
Goodness.
Just to get US employment back to pre-GFC levels.
So, I mean, this is all happening offshore in foreign economies, and yet seemingly having a very, very large bearing on our own market. Is that the case, and is that something you expect to continue, the influences it's happening here in Australia?
Yeah, most definitely. If we could, I think the best point to allude to here is, of course, the currency. I mean, what better bellwether or barometer for a nation's economy can you have in a free-floating exchange rate system than a currency? So, as we know, RBA Governor Glenn Stevens has reduced the cash rate in Australia in recent times, and again, like a good central banker, he has communicated quite clearly that he most likely will continue to cut the RBA cash rate later this year. So, that's the backdrop on this side of the ocean. We go over to the US, of course, it's Australian dollar versus US dollar, and quantitative easing, because the US unemployment picture is not getting any better, means that QE will continue. So what you've got there is that you've got very, very low interest rates in the US, but our interest rates over here are actually getting lower. And unfortunately, that simple interest rate arbitrage or relativity has been sufficient enough to send the Australian dollar down from its peak in April to where we were, I think, about 2 nights ago. We hit about 93 cents. So that's down about 11.5% in 8 weeks, which is absolutely huge. So, and of course, that there are ramifications throughout our economy due to the fact that we're a major commodity exporter, and commodities are, of course, priced in US dollars. So yeah, absolutely there are ramifications and impacts felt here in Australia simply because of what the US unemployment numbers are.
So with the US doing this enormous level, $80-odd billion of money printing a month, you've got the ECB, as you say, standing by to do whatever it takes should they need to. You've got our own interest rates coming down. Of course, in the background you have an enormous stimulatory program being enacted by Japan. With all that happening, how should people here in Australia position themselves? How should they look to take advantage?
Unfortunately, with currency, what we're kind of experiencing with interest rates worldwide is what I would flippantly refer to as a race to the bottom, unfortunately. So all these countries are trying to lower their interest rates so that their own currency, with the exception of Japan, who actually wants to weaken their own currency, that plays a major part. So I think the average person on the street here in Australia needs to understand and needs to appreciate that it is highly likely that the commodity cycle has already, if not already, gone past its peak. Our terms of trade have been the highest that they've been in 100+ years. The exchange rate has finally started to move below parity. In addition to that, in Australia, you've got a labour market which is possibly not in the best shape. So the average Australian needs to appreciate what drives the Australian economy, which means where do they hold their stocks, and of course it's the big four banks and the two miners that most people are in love with. But again, as we've seen with today, even today with the job losses from Target, is that the high Australian dollar has very, very much hurt the manufacturing sector, the services sector in this country, and what we possibly are beginning to see now is the impact of a slowdown in global demand for commodities. So I think that the average Australian investor just needs to be cognizant of those facts. And again, perhaps a rotation out of what they may have held as their put in the bottom drawer type equity positions may need to be reviewed as we go through the remainder of calendar 2013.
All right, Marcel, got to go, but as always, great to talk and get your analysis. Thanks a lot.
Thanks, James. Take care.